Our first profitability ratio is the gross profit margin, and it's simply calculated as gross profit divided by sales. So take the income statement you can see there, and we take our gross profit of 157,500 and divide it by sales of 350,000, and that gives us a gross profit margin of 45%. So we're more interested in this subject not in how to calculate it, but in what it means. So what does that mean? It means that for every dollar of sales that comes into the income statement, once we take out our cost of goods sold, that'll give us a gross profit of 45 cents. So that is, I know the cost of goods sold must be 55 cents because the gross profit is 45% of sales. So that must mean if this was $1 and this was 45 cents, the cost of goods sold was 55 cents. So that's a good way of thinking of it. How much is left of the sale once we take out the cost of goods sold? So our actual formal way to interpret it will say for every dollar the firm generates in sales, the gross profit of 45 cents is earned. This is once the cost of goods sold has been deducted. We can also look at it as a chart. We'll look at a graph and say here's $1 of sales. 55 cents of that dollar will be cost of goods sold. What that means is there'll be a bit left over for us, and that's called our gross profit. So in this case, that's 45 cents of every sales dollar. We can need to interpret the trend from time to time. So if it was 45% this year, what does that mean? It means for every sales dollar, we earned a gross profit of 45 cents. If that went down to 31%, what that means is for every sales dollar, we actually only earned a gross profit of 31 cents. So what must have happened is our cost of goods sold must have gone up to 69 cents from 55 cents. And that's a bad trend. Our profitability is worse. We are earning less gross profit on each sale. If the ratio went up from 45 to 56, what that means is for every dollar of sales that came in, by the time we took out our cost of goods sold, that left 56 cents of gross profit. So that's a much better trend. We've actually managed to lower our cost of goods sold as a percentage of the sales dollar. So that would indicate better profitability because we are earning more gross profit on each sale. How to improve it? If we get asked for strategies to improve it, well, looking at it mathematically, if it was a gross profit of 40,000 last year on sales of 100, that was 40%. The first way to improve it would be to make sales go up. So we could increase revenue from 100 to 110. We might sell the exact same number of goods, which was 60,000, but our gross profit will subsequently go up to 50. Now, if we rearrange the numbers, we'll end up with a gross profit of 50 divided by 110. That actually made our gross profit go up to 45.5%, and all we did was increase sales. The second way we can improve it is by, if it was 40% last year, we can then go and lower our cost of goods sold. So in this case, maybe things are tight, we can't sell any more goods, but we can buy them cheaper. So we go and manage to get the same amount of goods, but we only incur $50,000. We manage to still sell them for 100, and that'll flow through to our gross profit, which is 50,000. Putting our numbers into the formula, we'll end up with a gross profit of 50,000 divided by sales of 100. That will actually make our gross profit go up, and that's interesting because we didn't sell $1 more of anything. All we did was sell the same amount and lower the cost of goods sold.